In the time it takes you to watch this video, China will export another car, not to a dealership down the street, to Russia, to Brazil, to Mexico, to markets that used to belong to Toyota, to Volkswagen, to Ford. 7.1 million cars left Chinese ports last year alone. And by the end of this year, that number crosses 10 million. This isn't a comeback story. This is a takeover, and most of the world hasn't even noticed it's already over. For 100 years, more or less, since the first assembly lines started rolling in the early 20th century, the car industry had a shape everyone understood. Germany built engines. Japan built reliability. America built size and status. China built the parts nobody wanted to build themselves. Cheap, fast, and largely invisible. That shape is gone now, completely gone. It didn't collapse in a crash or a headline, the way industry shifts usually get remembered. It eroded, quietly, over about a decade, until one day people looked up and realized the biggest car company on earth by volume wasn't German or Japanese or American, it was Chinese. And the machine behind it isn't slowing down, it's just getting started. Let's start with this single number that should stop you cold, right out of the gate before we go anywhere else. China's auto industry currently has the capacity to build 50 million vehicles a year. 50 million. To put that in perspective, that's nearly a third more than the entire country sold in its best year ever, which was 2025. That is an almost unimaginable amount of idle production capacity, sitting in factories across dozens of Chinese provinces, ready to be turned on. And here's the thing about idle capacity in a capitalist system. Communist government or not, it doesn't stay idle. It gets sold somewhere to someone at a price the rest of the world's automakers simply cannot match. That's the engine driving everything you're about to hear. Not ideology, not central planning for its own sake, overcapacity and the absolute necessity of finding buyers for it anywhere on the planet that will take them. So where's it all going? Let's follow the actual data, because the numbers here are more dramatic than most people realize. In the first half of this year, the destinations for Chinese passenger vehicle exports shifted in a way that would have seemed impossible 5 years ago. Russia reclaimed the number one spot, taking in over 430,000 vehicles, a surge of more than 150% compared to the year before. Brazil came in second, with close to 400,000 units, up over 150% as well. Two of the largest, most strategically important auto markets on Earth, and Chinese brands are now the ones filling the shelves. Why? Because the market vacuum is real. European brands, American brands, Japanese and Korean brands have been retreating from markets like Russia for political and logistical reasons, and Chinese manufacturers didn't hesitate for a second. They didn't debate it in a boardroom for 18 months. They moved in. Great Wall Motors plant in Tula. Russia started ramping up local production. Geely built a joint venture in Belarus specifically to serve markets that Western brands had abandoned. Chery set up knockdown assembly lines, meaning they ship the parts and assemble locally to get around tariffs and localize their presence fast. This isn't a company shipping containers overseas and hoping for the best. This is a coordinated full value chain expansion, and it's happening on a timeline that Western auto executives are still struggling to comprehend. There's a phrase one senior Chinese auto executive used recently that captures the shift perfectly. The industry is moving from simple product exports to coordinated full industry chain exports. Read that again. It's not just cars leaving the country anymore. It's the entire ecosystem. The factories, the supply chains, the assembly capability, the local production, being planted in foreign soil, on foreign continents, under foreign flags, but built and controlled by Chinese capital and Chinese engineering. That is a fundamentally different kind of globalization than what we saw from Japan in the 80s or Korea in the 90s. Those countries exported cars. China is exporting industrial capability itself, and it's working. Analysts now believe China will break the 10 million export mark this year, a level that would have sounded like fantasy a decade ago. But here's the part that really matters, the part that separates this moment from just another chapter of cheap manufacturing conquering a market on price alone. The export mix is shifting hard toward electrification. New energy vehicles, meaning full electrics and plug-in hybrids combined, now make up roughly 43% of everything China ships overseas. That's not a coincidence. That's a country that figured out how to win a technology transition before its competitors even agreed the transition was inevitable. Because here's what's happening inside China's own borders, and it's arguably an even bigger story than the export numbers. The debate over whether electric vehicles would actually win in the marketplace, the debate that's still raging in American living rooms, in European parliaments, in car dealership showrooms from Ohio to Bavaria. That debate is completely over in China. Finished, decided. New energy vehicles now account for nearly 60% of all vehicle shipments in the country, and more than 60% of passenger vehicle sales specifically. For the first time, electrified vehicles have permanently overtaken gasoline vehicles in the world's largest car market. Not temporarily, not as a blip tied to a government subsidy program. structurally, permanently. The transition has been decided, and the only question left on the table is which companies will be the long-term winners of an already electric market. Let that sink in for a second, because it changes how you should think about every headline you read about EV sales slowing down in the West. Yes, electric vehicle adoption has been bumpy in the United States. Yes, some European automakers have walked back their EV timelines and reintroduced hybrid and gasoline models to protect near-term profits. But that hesitation, that back and forth, that political football that electric vehicles have become in Western democracies, none of that is happening in China anymore. China crossed what analysts call the threshold from policy-driven to market-driven electrification. Meaning, in the early years, the government pushed EVs with subsidies and mandates. Now, consumers are simply choosing them on their own because the cars are good, because the software is better, because the charging infrastructure exists, and because the price makes sense. The subsidy training wheels came off, and the bicycle kept riding itself forward. Meanwhile, the United States and Europe remain far more dependent on incentives, hybrids as a bridge technology, and fragile consumer confidence that swings with every election cycle and every interest rate announcement. That is a structural divergence, not a temporary gap. And structural gaps are much, much harder to close. Now, I want to be honest with you, because this story isn't a straight line up and to the right. China's domestic car market is actually going through real pain right now. Retail car sales inside China fell over 20% in the first half of this year compared to the year before. That is not a small dip, that's a serious contraction. Government subsidy programs that had propped up demand for years have been pulled back or restructured. Consumer confidence is softer than it's been in a long time, weighed down by a broader economic slowdown, a property market crisis that's bled into household wealth and spending habits, and a generation of younger Chinese consumers who are simply more cautious with money than their parents were. So don't let the export headlines fool you into thinking everything in China is booming across the board. It isn't. The domestic market is going through a genuine reckoning. But here's the strategic pivot that makes this story so important. And it's the single most important idea in this entire video. Chinese automakers didn't panic when domestic demand softened. They didn't cut production and wait it out the way an American or European company might. They redirected the exact same manufacturing capacity outward toward the rest of the world, and they used exports to keep their factories running, their workers employed, and their unit economics improving even while their home market cooled off. Exports evolved from what used to be a relief valve for excess capacity into the industry's actual primary growth engine, the thing supporting scale, keeping factory utilization high, and increasingly driving real profitability. That's a level of strategic agility that most Western auto executives can only dream about, because most Western automakers don't have a 50 million unit factory network sitting there, ready to redeploy at a moment's notice. So who exactly is winning inside China, now that the dust from years of brutal competition is starting to settle? The numbers here are stark. Domestic Chinese brands, meaning companies actually owned and headquartered in China, not joint ventures with foreign automakers, are now expected to capture somewhere between 68 and 69% of all car sales inside China this year. 68 to 69%. Think about what that number used to look like just 15 years ago, when foreign brands and their local joint ventures dominated nearly every showroom in every major Chinese city. When owning a Volkswagen or a Buick was a status symbol that said, you'd made it. That world is essentially gone. BYD leads the pack as the clear domestic champion, having sold 3.5 million vehicles last year alone, a number that puts it in the same conversation as the largest, most established automakers on the planet. Behind BYD comes a cluster of increasingly serious competitors. Chery, Geely, the newer Galaxy brand, and Changan, all fighting it out in a market that has become one of the most competitive, most cutthroat automotive battlegrounds in human history. And that brutal internal competition is exactly why Chinese cars have gotten so good, so fast. When you have dozens of serious manufacturers all fighting for survival in the same market, with government subsidies fading and consumer wallets tightening, you don't get lazy, complacent companies coasting on brand reputation. You get relentless innovation, because the alternative is bankruptcy. Analysts who watch this space closely have started using genuinely alarming language to describe what's coming for the industry's weaker players. They're calling it an extinction event, not a shakeout, not a correction. An extinction event where the companies that can't keep pace with the technology, the pricing, and the manufacturing efficiency simply disappear, get absorbed, or get pushed out of the market entirely. This is going to continue to be a brutal year, one industry analyst put it bluntly, and there's no meaningful relief expected on the horizon in the near term. Now let's talk about what's actually happening inside these cars, because the story here goes way beyond who's cheaper or who's selling more units. The entire definition of what a car even is has shifted underneath everyone's feet, and China is at the center of that shift. purchase decisions inside China are now being driven more by the quality of a car's AI driving software and the depth of its digital ecosystem than by traditional mechanical attributes like horsepower, engine refinement, or ride quality. Read that again because it's a genuinely historic reversal. For 100 years, people bought cars based on how the engine sounded, how the suspension handled a corner, how the leather smelled. Now, Chinese consumers are choosing cars the way people choose smartphones, based on the operating system, the app ecosystem, how smart the assistant is, how seamless the over-the-air updates feel, and whether the self-driving software actually works as advertised. That is going to fundamentally change how vehicles get developed, how they get priced, how they get serviced over their lifetime, and how they get upgraded years after you drive them off the lot. And it's going to redistribute the value that used to sit comfortably with traditional automakers toward whoever controls the software layer instead. This software shift connects directly to another quiet revolution happening in Chinese factories right now, the race to control the chips. For years, China's auto industry, like everyone else's, depended heavily on foreign semiconductor companies for the silicon that powers modern vehicles, the chips that run autopilot systems, infotainment screens, gateway modules, and vehicle control units. That dependence is being systematically unwound, chip by chip, contract by contract. Chinese automakers and domestic semiconductor companies are now building their own automotive systems on a chip, consolidating what used to be several separate foreign-sourced components into unified architectures designed, engineered, and manufactured entirely within China's own borders. Mass production contracts for these domestic chips are already signed and already running. The dependence on foreign silicon that defined this industry just 3 years ago is disappearing in real time. And when you combine that chip independence with software-first vehicle design, you get something genuinely new in the history of the automobile. Vehicles that are being built from the ground up as AI terminals, as computers on wheels that happen to also transport people, rather than as mechanical devices that happen to have some electronics bolted on as an afterthought. If you want to see all of this converge in one place, you only had to walk the floor of this year's Beijing Auto Show. The event took over 380,000 square meters of exhibition space, more than the previous show, and well ahead of the major international auto shows in Munich, Detroit, Paris, and Tokyo combined in terms of scale and ambition. The show's theme was simply Future of Intelligence, and walking through those exhibition halls, you didn't just see new car models with slightly different bumpers and slightly different infotainment screens. You saw an entire industry at what analysts are calling a genuine strategic inflection point, a moment where Chinese automakers and their component suppliers are no longer playing catch-up to Western and Japanese engineering standards. They are actively redefining what the terms of global competition even are. And here's a detail that should worry every multinational auto executive watching this trend from a distance. Foreign automakers who still operate in China have spent years talking about deep localization, building local design teams, local research centers, local supply chains inside China to compete more effectively with domestic brands. But according to people who actually walk these auto shows and study these companies closely, the localization slogans coming from many multinational booths are still lagging well behind those same companies' actual product timelines, their real research and development investment, and critically, their organizational decision-making authority inside China. In plain English, a lot of these companies are saying the right things in press releases, but they haven't actually restructured their organizations to move at Chinese speed or make decisions with Chinese-level autonomy. Slogans change faster than organizations do, and the gap between the multinationals that have genuinely made that leap and the ones still testing the water and hedging their bets is very likely going to show up in brutal, undeniable market share losses over the next 2 to 3 years. Meanwhile, something else caught serious attention at this year's show: the sheer breadth of companies participating in China's outward expansion. This isn't just the handful of flashy electric vehicle startups that dominated headlines a few years back, the ones with the futuristic showrooms and the celebrity founders. The push to go global now extends deep into the supply chain, into battery makers, into component manufacturers, into software companies, into the entire industrial ecosystem that supports vehicle production. China isn't just exporting finished cars anymore. It's exporting the entire apparatus needed to build cars, sell cars, finance cars, and service cars anywhere in the world that will have them. So where does this actually leave the rest of the global auto industry? Let's be specific about the pressure this is putting on legacy manufacturers, because it's not abstract anymore. It's showing up in earnings reports and plant closures right now. Nearly every report of profit declines, factory closures, or job cuts coming out of the German and broader European automotive industry these days mentions China somewhere in the explanation. The growing competitive pressure from what is now, by a wide margin, the largest car exporting nation on earth, is cited as a direct cause of the difficulties Western manufacturers are facing at home. This isn't speculation from outside commentators. It's coming directly from the companies themselves in their own investor calls, explaining to shareholders why margins are shrinking and why market share is eroding in markets they used to consider safely their own. Japanese and Korean manufacturers once expanded aggressively into Europe decades ago, building factories, establishing dealer networks, and slowly, patiently winning over skeptical European consumers with reliability and value. Now, a new wave of brands is following that exact same playbook, except this time, the brands carry Chinese names instead of Japanese or Korean ones, and they're moving at a pace that makes the original Japanese and Korean expansions of the 70s and 80s look almost leisurely by comparison. The emergence of this entire new competitive ecosystem, the innovation velocity, the ambition of Chinese engineers and entrepreneurs, the sheer scale of capital being deployed, has become impossible for anyone in the global industry to ignore any longer, whether they want to admit it publicly or not. Now, it's worth stepping back and asking whether this rapid growth trajectory is sustainable, because even the most bullish analysts covering this industry acknowledge real headwinds. Early in this year, there was a noticeable slowdown in China's domestic passenger vehicle segment, tied largely to policy timing and post-holiday adjustments after a surge driven by incentive programs in the prior year. Commercial vehicle shipments, interestingly, held relatively steady through that same period, suggesting the softness was concentrated specifically in consumer passenger cars, rather than the industry as a whole. Most analysts who watch this space closely characterize that particular slowdown as cyclical rather than structural, meaning it's a temporary adjustment tied to specific policy changes and seasonal timing, not a fundamental weakening of underlying demand for Chinese vehicles. But that assessment could shift quickly if the broader economic pressures inside China, the property market troubles, the cautious younger consumer base, the fading subsidy programs, turn out to be more persistent than expected. There's also a broader geopolitical dimension layered on top of all of this that's impossible to ignore. As China's export dominance grows, more countries are going to face the same uncomfortable political choice that Europe and the United States have already started wrestling with. Do you protect your domestic auto industry with tariffs and trade barriers, potentially sacrificing consumer access to cheaper, increasingly capable vehicles? Or do you open your market and accept that Chinese brands will likely come to dominate it the same way they've dominated markets like Russia and Brazil? There's no easy answer here, and different governments are already choosing very different paths. Some voices in this space are actively warning against what they call a dangerous bifurcation into two incompatible global mobility systems. One built around Chinese technology and standards, the other built around Western technology and standards, operating in parallel with limited compatibility between them. Instead, some analysts are advocating for a kind of strategic interdependence, combining China's undeniable manufacturing scale and cost efficiency with Western innovation strengths, arguing that's the fastest and most rational path toward a genuinely global, sustainable transition away from gasoline power. Whether governments actually choose cooperation over protectionism remains one of the biggest open questions hanging over this entire industry right now. Let's talk about the battery, because none of this, the exports, the software shift, the chip independence, works without it, and this is the piece of the puzzle that took the longest to build and is the hardest for any competitor to replicate quickly. China didn't just win the electric vehicle race by building good-looking cars. It won by controlling the entire battery supply chain, from the raw lithium and cobalt processing all the way through to the finished battery packs rolling off assembly lines. Chinese battery makers process the overwhelming majority of the world's lithium, refine most of its cobalt, and manufacture the vast bulk of the battery cells that power electric vehicles everywhere on the planet, not just inside China. That's not something a rival country can replicate with a single factory announcement or a government grant program. That takes decades of mining investments, refining infrastructure, chemical engineering expertise, and manufacturing scale that simply doesn't exist anywhere else at the same magnitude. Every time a Western automaker announces a new battery plant, a new gigafactory, a new supply deal, they're still, in most cases, either licensing Chinese battery technology, buying Chinese-made cells directly, or competing against a Chinese cost structure that took a decade and hundreds of billions of dollars of investment to build. You cannot shortcut that kind of industrial depth, no matter how much political will exists to try. And that battery advantage feeds directly into price, which remains the single most brutal weapon in this entire competitive story. Chinese electric vehicles routinely hit the market at price points that would be simply impossible for European, American, Japanese, or Korean manufacturers to match, while still turning a profit. Part of that is labor cost, part of it is scale, but a huge part of it is that Chinese manufacturers have compressed the cost of the single most expensive component in any electric vehicle, the battery pack, down to a level competitors are still years away from reaching. When a Chinese-built electric sedan with genuinely impressive range, a capable driver assistance system, and a sleek, tech-forward interior can be sold profitably for a price that undercuts a comparable Western vehicle by 30 or 40%. That's not really a marketing problem for the competition to solve with a clever advertising campaign. That's a fundamental structural cost disadvantage, and structural disadvantages don't get fixed with slogans or short-term subsidies. They get fixed, if they get fixed at all, with the same kind of decade-long industrial investment China already made. There's also the consumer experience layer that doesn't get talked about enough outside of China, but genuinely matters to understanding why this shift happened so fast. Charging infrastructure inside China isn't an afterthought bolted onto highway rest, stops the way it still often feels in parts of Europe and North America. It's dense, it's fast, and in many major Chinese cities, it's becoming genuinely more convenient to own an electric vehicle than a gasoline one. Battery swap stations, ultra-fast charging corridors along major highways, and integration with residential and commercial parking have all matured at a pace that Western infrastructure planning, bogged down by permitting delays, grid capacity constraints, and fragmented private ownership of charging networks, simply hasn't matched. When the everyday experience of owning an EV stops being a compromise and starts being a genuine upgrade over a gasoline car, consumer adoption stops needing government incentives to sustain itself. That's exactly the threshold China appears to have crossed, and it's a big part of why the shift from policy-driven to market-driven electrification actually held once the subsidies started fading. It's also worth understanding just how young and aggressive the competitive landscape inside China actually is, because it explains the pace of innovation better than almost anything else. Many of the most important Chinese auto brands driving this global expansion didn't exist as serious car manufacturers even 15 years ago. Companies that started as battery makers, as smartphone manufacturers, or as scrappy startups with almost no brand recognition have, in the span of a single decade, become globally significant automakers shipping hundreds of thousands of vehicles a year to markets on nearly every continent. That kind of compressed timeline simply doesn't happen in mature, slow-moving industries. It happens when an entire government, an entire financial system, and an entire generation of engineers all decide, more or less simultaneously, that a specific technology transition is not optional, and then organize every available resource behind making that transition happen as fast as humanly possible. Compare that to the position most legacy Western and Japanese automakers found themselves in. These are companies with 100 years of engineering heritage built almost entirely around the internal combustion engine. Companies with massive existing factories, massive existing supplier networks, and massive existing workforces all built to manufacture and service gasoline-powered vehicles. Pivoting an organization that size, with that much invested in the old technology, toward an entirely new powertrain, an entirely new software architecture, and an entirely new relationship with semiconductor suppliers isn't something you do with a single bold announcement at an auto show. It requires years of organizational restructuring. And every year spent restructuring is another year Chinese competitors spend widening the gap even further. That's the trap legacy automakers find themselves caught in right now, and it's a large part of why the profit warnings and plant closures keep piling up across the European and American auto sectors. So what does all of this actually mean if you're just someone watching from the outside? Not a policymaker, not an auto executive, just a person trying to understand where the world is heading. It means the car you buy 5 years from now, no matter what country you live in, is very likely going to be shaped by decisions being made in Chinese design studios and Chinese battery factories right now, today, whether the badge on the hood says a Chinese name or not. It means the software running your next vehicle, the chips powering it, the way you interact with it every single morning on your commute, are all being redefined by an industry that decided years ago electrification wasn't a maybe, it was inevitable, and got a decade-long head start acting on that conviction, while much of the rest of the world was still debating whether it was even real. It means the balance of power in one of the largest, most economically important industries on the planet, an industry that touches steel, semiconductors, software, mining, logistics, and tens of millions of jobs across dozens of countries, has shifted more dramatically in the last 5 years than it did in the previous 50. And it means the companies, the countries, and frankly the consumers who recognize that shift early, who adapt to it honestly instead of denying it, are going to be the ones writing the next chapter of this industry's history. Everyone else is going to be reading about it, wondering exactly when it happened, and realizing, much like you just did watching this video, that it already has, quietly, factory by factory, port by port, while the rest of the world was still arguing about whether it could.